Hi everyone and welcome to the Everyman Investor. So it's been a couple of weeks since I last updated on the stock market. The reason being that the stock market has actually been quite lost recently, and everybody is looking for a direction to go in terms of whether to buy or to sell. So the reason for that being that the economic data has come out really very schizophrenic. Um, one day the economy data comes out bad for the market, the other day it comes out good. So the market sort of goes up and down. The latest close was an all-time high for the S&P 500, mainly on a very good consumer sentiment report, which I will go through in a bit. So as you can see, the S&P 500 has been sort of trading in a very nice range over the past month or so, and its recent breakout was just yesterday's session. Now the reason being that the data has been mixed, and people are now realizing the Fed is not probably not going to be cutting 6 times as what the market expects. 3 times is realistic, but it all depends on how things are going. The other thing is that Q4 earnings season is actually in full swing at the moment in time. Last week was the first week of Q4 earnings season. Let's take a look at some of the things that have happened. So basically, a confused market is a stock picker's market. If you pick stocks with good earnings, it's likely the stocks will go up. If you pick stocks with bad earnings, the stocks will go down. Now, if you're an active investor, this is really a good time to pick up stocks. Um, you have to monitor your earnings call and earnings report closely for the stocks you're interested in. Now, if you're a passive investor, I would say buy the S&P 500 ETF on dips, or if you buy the Nasdaq on the dip, that'll be fine as well. Um, so, saying that I read recently was that it is not so much timing the market, but time in the market. So the duration should balance out the ups and downs, but at the same time, if you want higher conviction picks, then you really need to pay close attention to what stocks you are buying. Now, as I mentioned, earnings will point the way for individual stocks, and this is the most important factor in determining how your stocks move. So here have how has earnings been so far? Okay, so a couple of the health insurance companies have released their earnings, or made announcement around their earnings, and because of the clearing of the backlog of procedures from COVID and high healthcare utilization rates, it's affecting their margins and their profits. So the health insurers have in general dropped. If you're looking for a good time to pick it up, now might not be a bad time, but you need to look at the individual company to see whether or not the valuation is sensible. That said, um, one of the largest health insurers actually did mention that despite the increase of healthcare utilization costs, they do have very good visibility into their profits for the next year, and they are convinced that they will continue to grow their earnings, which will basically boost their share price. Now, for banks, on the other hand, you expect banks to be making a lot of money with the high interest rates because that's what they're charging you and me. But the thing is, actually, some banks are actually reporting losses, and some banks have reported a good earnings, or sorry, better than expected earnings. Not good, but better than what the analysts expect. But they are cautious on the outlook. So it's been a very mixed bag. In fact, Citibank is thinking of, she has announced that it's going to cut jobs to boost its profitability. Now, for semiconductors, on the other hand, stocks have been going up a lot because TSMC reported earnings and suggested that the inventories are clearing for its customers, so it's expecting more orders, which will boost its earnings. So just about every single semiconductor stock is up. I would say watch carefully for the various earnings. The most popular stocks will be Nvidia and AMD. Nvidia is a problem because looking at its valuation, it is somewhat rich in valuation. But if you look at the forward earnings, then it actually does not look that bad. But then again, many of the companies are actually looking towards custom chips for their own use. And a lot of the big tech companies are actually in development for these custom chips. So while I think Nvidia has got room to run for a couple of years more, until these new chips from the various big companies like Facebook or Microsoft, for example, come into the picture, it's probably a good idea to be very careful and watch how Nvidia's earnings go before making a decision on whether you want to buy. I have not touched the stock. I own a small amount, and I have not bought more. It just is too risky for me at the moment in time. Now, AI stocks are running up on very high expectations that their earnings will be growing and growing very much. Um, and this is somewhat of a perplexing conundrum for in long-term investors, in the sense that um, there are people talking about the 2000 dot-com bubble, but there are people saying that this is 1998 and it's got a couple of years to run for you to take profits on. So again, this is one of those situations where you need to assess your own risk before deciding what to do in terms of buying or not buying an AI stock. Now, so far in general, Q4 earnings are pretty much flat. They are not going up. Earnings growth is very minimal, put it this way. And that basically is what people are calling a earnings bottom. And most analysts are expecting earnings growth to accelerate in 2024. The question is, will that come true? As we know, analysts aren't particularly accurate a lot of times. Now, as I mentioned, the economic data has been really schizophrenic. So, for core CPI, consumer price, it's been up 3.9% year over year versus expected 3.8%. Now, the Fed's target is 2%, and this sent the market scurrying to sell off. Then the PPI came out, which came in at 1.8% year over year, which is under the 1.9% that was expected, and under the 2% Fed target for inflation, which sent the market going up. Now, the PPI should translate into the CPI in the near future, given that if your producer price drops, they should be charging a consumer less, or rather, they should be increasing their prices less for a consumer, and hence CPI should come down. That said, companies can still continue to want to profit more. So whether CPI comes down or not is questionable. Then came the Empire State Manufacturing Survey, which is basically a survey of manufacturing in the US, and it came in at negative 43.7. So anything negative is contraction, and anything positive is expansion. It was expected to come in at negative 4, which means a minimal contraction. From the look of this, the manufacturing sector in the US is collapsing, and the market sold off again. And then the US retail sales came in at a growth of 0.6% versus the expected of 0.4%, which basically led people to think that the economy is too strong and the Fed is not going to cut rates, which led to a market sell-off again. Jobless claims came in bad for the market because it was light, 187,000 versus 208,000 expected. Again, which makes the case for the Fed not cutting. And then what happened is the latest report was the consumer sentiment, which was 78.8 versus the expected 69.7. Now, the more positive, the happier the consumer is, and basically this lifted the market in the latest session and now at an all-time high. Whether you'll stay at all-time high is anyone's guess. Now, so how do you find a direction in such a confused, volatile market? So, as I mentioned, earnings. If you are a stock picker, then earnings report and earnings call is very, very important for every company you're interested in. So I sat through 2 earnings calls already, even though earnings season started just last week. One for a stock I own, one for a stock I don't own, but I'm looking at. And both earnings calls were informative in terms of the company mapping out their sort of roadmap to more profits. Did it convince me to buy? No, it didn't. But it convinced me that I should not be selling, even though I've got a profit in the one that I own at the moment in time. Buy the dip on the misunderstood earnings call. So the last Fortinet call was a disaster for the stock price. But the thing is, looking through the underlying fundamental earnings growth, the stock should not have dropped so much. And basically, if you are listening to the earnings call and looking through the details of the earnings report, then you will be able to find that it was a good buying opportunity, which basically got me a good profit, which I'm sitting on at the moment in time. And I'm probably not going to be selling anytime soon, because cybersecurity seems to be one of those areas whereby you can probably make a lot of money in for the next at least 5 to 10 years. And watch for trends. Okay, so basically what happened is that the latest reporting, they came out on the vehicle market. There are Teslas basically sitting down frozen in the coal of the US at the moment in time, because EV battery apparently needs to be in a certain temperature range for it to be able to be charged. Too hot, it cannot be charged. Too cold, it cannot be charged. In short, you need ideal temperatures for a battery electric vehicle to be charged. And because of that reason, there are Teslas basically sitting on the roadside in the US at the moment. And a lot of people are now thinking whether or not they should actually be buying electric vehicles. They are pure battery electric vehicles. So that's why Tesla stock is tanking. Now, on the other hand, people do want to buy a car that has sort of greener footprint for the environment, and that's why hybrids are now in favor, and that's why Toyota stock is going in the opposite direction of Tesla's. It's been going up, up, and up. So full disclosure, I bought Toyota on a dip last month or the month before, and it's been going up since then. And basically, I did that because Toyota's uh, PE ratio and the number of cars it's manufacturing and selling far outweighs any other car manufacturer, and it is trading at it's trading at 10% of Tesla's PE, which means to say that it is very undervalued compared to Tesla. At the same time, it is growing its profits. So, which is why I said the earnings call and the earnings report are very, very important. Now, there were a couple of scandals about falsifying data and all, which is when the dip occurred and which is when I went in. So, if you do want to pick stocks individually, always keep an eye out for news and always keep an eye out on the earnings reports. That's when you know when to buy, especially if it drops below my favorite metric, which is the median PE ratio. Now, the next core PCE is coming out on 26th of January, and the next FOMC is coming out on 30th, 31st January. So the thing is, it's very unlikely the Fed will be making any moves at all in January. The market is pricing in a March rate cut, but that is somewhat unrealistic given that, as you saw, the CPI came in at 3.8%, and the PCE is not expected to come in at 2% anytime soon. So the restrictive policy is probably more likely than not for the next at least 3 to 6 months, which is not good news for the stock market. But the thing is, it can be good news for companies with strong fundamentals and very little debt. Without debt, to be very honest, the interest rates do not matter. So if you can find a company that has got practically no debt, for example, Fortinet has got practically no debt, it is a good company to invest in for the simple reason the company does not need to worry about factoring in paying of interest for whatever interest rate it is at the moment in time. So that would be a good place to start to find companies to own. So thank you for watching. I hope this was informative, and that it will help you as we go through the next earnings season. I will probably make another video after the PCE comes out and the FOMC meeting is concluded. And by that time, we should be another 2 weeks into the Q4 earnings season, and we should see much more in terms of the earnings trends. So thank you for watching, and I hope to see you again in my next video.